Yo, what's going on, premium chasers? In today's video, I'm going to be sharing with you guys a new options trading strategy that I am deploying on one of my favorite wheel strategy stocks, and that is SoFi. Also, one lucky commenter down below on today's video is going to win our cash secured puts for busy people course completely for free that I sell every day for $200. It's yours free. Drop a comment, hit that like button and that subscribe button. And of course, I hope you are having a God blessed day. Let's go over the shoulder and I'm going to share with you guys what this strategy entails, because we're kind of merging both a covered call and a cash secured put position that both expire on the same date and time. And I want to kind of walk you through my strategy for running this on SoFi. So we obviously see SoFi has been on an absolute tear. I have 29 calls expiring this Friday. I'm letting them shares go. About 15% gain for me in a literal week when I bought my shares at 26 on the drop that we saw here last Friday, and obviously a big run up. For me, I'm very, very bullish on SoFi, and I'm very long-term. I know there's going to be bumps and bruises along the way, but this is why I'm deploying this strategy on this. This is a strategy that is perfect if you are somebody that, or if you have a stock that you want to play both directions in, meaning that you don't care if you sell your stock shares at a really good price, and then also you really kind of want to get a sign. Now this is few and far between, at least for me, where I genuinely want to be on both sides of the coin, but this allows us to double dip on the premium, and we let me just show you. Okay, so the strategy is called a covered strangle, and this is exactly how it works. Let's head over to our Robinhood for our demo account here. I'm actually going to be running this full strategy using the SoFi options chain. Wish me luck. It's not that good, but it's just version 1. But with that said, the first thing we're going to be doing is we sell a put. Now, I'm going to be doing these on weeklies, okay, personally. I'm going to be running this SoFi strategy on a weekly basis. So what I'm going to be saying every single week, I want to buy 100 shares of SoFi. Every single week, I want to buy 100 shares of SoFi. That's what I'm going to be saying. So I'm going to go out, let's just say 9 days around a week, right? It doesn't have to, some of you guys just micromanage the crap out of stuff and then you just end up not doing anything. For me, if it's like, that's what's great about being an option seller. It doesn't have to be exactly 5 days or 7 days, whatever. I'm like, okay, if I wanted to do it today, I can do it today and I'll just choose the 9th. Not a big deal. All right. The world, we're still collecting the juice. All right. So with that said, I'm saying here, I'm willing to buy 100 shares of SoFi on the 21st at close, right? That's what a cash secured put is. You obviously need to make sure you have cash in your account for this. Okay. Now I'm naming my price. Now, obviously SoFi is on a tear. Selling puts when a stock is blowing past its top Bollinger Band, like SoFi is now up 4.5%. Oh my goodness, SoFi. I love you and I hate you at the same time. But with that said, obviously it's tearing up today. So it's not really ideal to sell puts. Usually the best time to sell puts is when we're crashing hard and we're oversold on the RSI and we're working our way towards the bottom Bollinger Band, right? But with that said, this strategy, we don't really care. At least me, I don't really care, right? Because I'm bullish on SoFi long-term anyway. So for me here, I'm looking at 25 to 30 delta strikes, okay? So right here, if we scroll down, let's say at the it's wild that the 30s are a 23 delta. What? This is insane. But let me show you guys how this works. I might have to be a little bit more aggressive here, but we'll do the 30s. What I'm saying, on the 21st, I'm willing to buy 100 shares of SoFi at $30. Now that's going to wrap up $3,000 of mine, right? So $3,000 of collateral to buy those, right? So you want to make sure everything I do is cash secured and covered. So I'm doing a cash secured, but 23 delta, not super aggressive here. Let's actually jump in because I like 27. Okay, that's perfect because in this play you want to get a sign. You don't mind getting a sign, like for me. So I'm going to be playing closer to that 30 range. So let's do this one. Let's do the 35s. Not the 35s. The 30 and $30.50 ones, and we're collecting. We'll say split it down the middle. We'll say $63 between the bid and ask. So we'll collect $63 here of premium, and we're locking up just $500 more dollars. So we're locking up $50 more dollars. Boom, there we go. We locked up 50 more bucks on this for a 2% return in a week. That's the first leg of this, right? So we're going to toss that in to our order here, right? We'll just toss in our review order, and we will leave that right there. Obviously, that collateral, like you're seeing here, is $3,050, okay? Now, the second thing we want to do is you want to make sure, so this first trade, we want to make sure we have 100 shares of or we have enough money, we have enough collateral, right? You want to make sure, you see, I don't use Robinhood, but I do it for educational purposes here. You guys know with my live portfolio here on the channel, I primarily use Fidelity. utility, and now I'm using the SoFi options chain, even though it's not that great. But with that said, now that we have our short put, our short cash secured put, what we want to now do is sell a covered call. Now this covered call, we want to make sure we have at least 100 shares. So we're going to flip to call. Now we leave it at the same expiration date here, okay? We do want to leave this as the same expiration date, at least the way I'm doing this covered strangle. Now, obviously, it goes without saying, we want to sell our 100 shares for higher than we bought them for, okay? So if you have 100 shares at the current cost basis of 32, let's just say that you bought, and you want to sell them at, let's say, 35. Now, again, here I'm playing the delta. I want to be at around a 25 to 30 delta, being a little bit more aggressive here. I'm an income investor, okay? I am primarily an income investor, especially when selling options, so that's where I focus. So right here, you can see my 34s are a 33 delta. That's a little too aggressive for me. I wouldn't take that one. I would go with the 35s that are just at that 0.24 chance of being assigned. So about a 25% chance that I'm going to get assigned my shares here. And you could see when I click this, I would collect, what would we collect about? Actually, it's all skewing here because I have this this leg and I don't have the, I don't actually have money in this account. So let me just get rid of this one trade here. And then I can show you guys on the actual calculators how this trade would look like. So we would collect $50 on the short call here that's expiring in 9 days. And we would collect, all right, let's just say $50. We collect $50 in premium, maybe a little bit more here now that it's moving, but we'll just say $50. So we'll go to our covered call calculator here. Let me zoom in here. All these calculators are free at the end of the Ark Options Strategy workshop. Click the first link in the description of today's video. 2-hour training on the Ark Options Strategy takes your wheel strategy gains to the next level by combining 5 sources of premium generation. Click that first link in the description. At the end, I give you my trade logs as well as my calculator. So we're collecting $50 of premium on that trade. Our strike of the option, right? That's what we're willing to sell our shares for, is $35, right? $35 right here. And our purchase strike price is your cost basis. What is your cost basis? I'm just going to assume you own 100 shares, right? Like at the current market value of SoFi, that's what I plan to do, is just buy outright 100 shares every week of this, or if only if they get called away. So that's what I'm going to do this Friday. Since my shares are going to get sold for $29, I also had about, $100 in premium, I'm pretty sure. So that's going to give me around $3,000 to then go out there and buy 100 shares of SoFi around the current market value to do the strategy. Plus I got my put in as well. And I'll cover that all in just a moment here. So I'm going back to my covered call here. I'm saying I purchased them for around current market value. Let's just say $32. So I'm getting a 1.56% return on this leg. Okay. Now on the covered call side, I obviously have the risk of selling my shares, but either way, it's all good because this strategy, the purpose of this is you're kind of playing both sides a little bit more. Now, it is more of a bullish strategy for sure, but what we're really hoping for in this play by playing the kind of like the 20 to 30 delta is that most of the time what happens is that on the cash secured put side, we are staying above our $30.50 strike price, meaning let's say on the 9th, right? On the 9th, when we go to our expiration date, we're trading above our cash secured put price, because if that's the case, the cash secured put expires worthless and we simply just walk away with that premium we collected up front. We will be able to manage these positions nicely as well, which is nice, right? They are more shorter. I'm going to be doing these on a weekly basis primarily though. So with that said, the 30/50s, if those that the idea is that the cash secured put is going to expire worthless. We will not be assigned, but if we are, okay, whatever, we're assigned at 30/50 and we wanted the stock anyway at a discounted rate to dollar cost average. Now on the covered call side, we want to obviously make sure that, or hope that SoFi stays below $35. That way we don't actually have to end up selling our shares. If it stays below $35, right, where our 100 shares or however many 100 shares contracts you did, it will be given back to you, and then we run the same exact play for the following week. So perfect premium chasing world is that both, right, that SoFi at the expiration is trading between but not at $30.50 and $35 a share, right? So let's say it's trading at like $33 on Friday. That means my cash secured put will expire worthless. I don't have to buy the shares, and then my covered call side expires is worthless as well, and it's just trading right in the middle. Now, why do I think that's kind of the case for SoFi, at least for me? Well, number one, obviously, 100%, I am okay buying more shares. That's the first and foremost thing. But I do believe this run up that we're seeing on SoFi right now, especially this entire week, it's going to lose a little bit of gas. Usually we do see a little bit of gas that gets lost that time. Now, who knows with SoFi, right? It's been on an absolute tear. That's why I like this strategy though, because either way, I'm winning. Either way, I win. Either way, if SoFi runs up, I'm going to sell my shares that I got at a nice profit of about 11% in a single week. Or if I end up having to buy my shares for a cheaper price to lower my cost base, is fantastic because I wanted to get that stock anyway. And now I'm getting it at a deeper discount, right? And then worst case, none of those happen. And I simply sneak away with both premium and run the play again the following week. If you want to learn more about this strategy and how we implement this, it's called the Ark Options Strategy. Click that first link in the description of today's video. You're going to watch a 2-hour training. And at the very end, I'm going to give you completely for free, no strings attached, my premium calculators as well as my trade log. Remember, guys, sell options, collect premiums, repeat. I'll see y'all tomorrow.